The world's third largest economy is beginning to pull out of its investments in the US dollar. Japan, a country that holds a staggering amount of US debt, starts selling off its US Treasury bonds. What does that mean for you? What does that mean for America? If the US economy is built on trust, what happens when that trust is shaken? As of September 2024, Japan is the top international investor in US Treasury bonds. How much is Japan currently holding? Here's the number: $1.1 trillion. That's the amount of US debt Japan is holding as of September 2024. No, you didn't mishear that. 1.1 trillion. Let's put that in perspective. Japan's holding alone is larger than the GDP of most countries. This isn't pocket change. This is Japan's economic backbone intertwined with the United States. Japan's investment is more than double what China holds in US debt and nearly 5 times what the UK has. Financial Times wrote in September 2024, Japan holds steady as US Treasury's top foreign holder. But why does this matter? Because for decades, this has been a stabilizing force. A quiet agreement that kept both economies linked. But now, the gears are shifting. Let's rewind to 1985. Japan was buying US Treasury bonds like a kid in a candy store. Why? Because they needed a safe haven for their savings. Post-World War II, Japan was rising from the ashes, and investing in US debt was one of the smartest moves they could make. In a 1992 article, Nikkei Asia wrote, Japan's bond holdings surge amidst economic crisis. The US economy was strong, the dollar was stable, and Treasury bonds were the safest bet in town. Then came the lost decade. Japan's economy hit a brick wall in the 1990s, but their investments in US Treasuries? That was the one thing they didn't have to worry about. US Treasuries weathered the storm. So for Japan, investing in US debt wasn't just about money, it was about survival. A 1992 Reuters headline reads, The Safe Bet, Why Japan Never Quit US Treasuries. If you are enjoying our content, please hit the like button. To help us even more, leave your thoughts and feedback in the comments. Please share this video to help us grow. Thank you. So, why the US? Why not invest somewhere else? The answer is simple. Safety. US Treasuries are considered to be the safest investment in the world. They're backed by the full faith and credit of the United States government. For Japan, a country with an aging population and an economy that thrives on stability, this was a no-brainer. The Economist wrote in March 2024, why US Treasuries are the safe harbor for Japanese savings. But it's more than just safety. It's about predictability. US Treasuries offer low-risk, reliable returns. Japan didn't want to gamble with its money. It wanted to park its wealth in an asset that would grow, slowly but surely. Norinchukin Bank, one of Japan's largest agricultural cooperatives, just made a huge move. Billions of dollars have been pulled from US Treasuries. According to a Reuters July 2024 article, Norinchukin leads the charge in ditching US Treasuries. Why? It's all about returns. With the Federal Reserve jacking up interest rates to combat inflation, US Treasuries aren't the golden goose they once were. In July 2024, Norinchukin shifted nearly $20 billion from Treasuries into corporate bonds and even real estate, anything to chase a higher yield. They're not alone. Mitsubishi UFJ, Sumitomo Mitsui, all are pulling back. Financial Times wrote in August 2024, Big banks, bigger moves. Why Japanese banks are changing course. Japan's big banks are watching the Fed closely and they're not waiting around for the fallout. But Japan's in a tough spot. Inflation is up, growth is down, and the yen, it's taken a nosedive, dropping 30% against the US dollar over the last decade. We're talking stagflation, low growth, high inflation, the nightmare combo for any economy. Add to that an aging population. Nearly 30% of Japanese citizens are over the age of 65. And you've got a recipe for serious economic strain. Japan's government is pumping money into pensions and healthcare, and it's coming at a cost. According to the Wall Street Journal in June 2024, yen hits 30-year low against dollar as Japan faces economic headwinds. A depreciating yen means that Japan needs more bang for its buck, or rather, more yen for its bond. And US Treasuries aren't cutting it. Japan's not just pulling back because they feel like it. This is strategy. Kishida pushes for diversification amid economic uncertainty, according to the Financial Times. Prime Minister Fumio Kishida's government has been quietly shifting Japan's foreign reserves into more diversified assets, like gold, corporate bonds, and even foreign equities. They're not ditching US Treasuries entirely, but they're hedging their bets. With the US raising interest rates, Japan sees an opportunity. Treasuries are still safe, but they're no longer the golden ticket. A headline by The Economist in August 2024 reads, "Japan's $1 trillion bet, moving away from US bonds." Japan is carefully planning its exit, looking for more lucrative investments. And with inflation eating into their returns, can you blame them? Jerome Powell has been in the hot seat lately. With US inflation hitting a 40-year high, the Fed has been forced to raise interest rates at a pace we haven't seen in decades. That means borrowing money just got a lot more expensive, both for the US and for foreign investors like Japan. Inflation is the thief in the night, eroding the value of those US bonds. For Japan, it means they're not getting the return they expected, and with interest rates climbing, the cost of holding treasuries is rising too. Japan and other foreign entities are looking elsewhere. Corporate bonds? Sure. Real estate? Absolutely. Even digital currencies are on the table. According to Reuters, foreign investors flee US bonds amid Fed tightening. Let's get real here. If Japan dumps its US and EU Treasury holdings in a big way, there will be consequences. Big ones. For the US, that means less demand for their debt. That drives up borrowing costs for the US government. We're talking about paying billions more in interest just to service the national debt. For the EU, the story is similar. Japan's been a major buyer of European debt for years. A pullback could mean a spike in borrowing costs for countries like Germany, France, and Italy. The Great Sell-Off. Japan's move could rock global markets, according to The Economist. And with Europe still struggling to bounce back from its own inflation crisis, this is the last thing they need. Let's think long-term. The US dollar is the global reserve currency. It's the bedrock of international trade. But if countries like Japan lose faith in our financial stability, others will follow. Right now, we have $7.6 trillion in foreign-held US debt. What happens if more countries follow Japan's lead? Interest rates soar, borrowing costs for the US government explode, and suddenly, we're not just talking about a recession. We're talking about something worse. Experts warn that a significant sell-off of US debt could lead to severe economic consequences, pushing the country closer to a default. It's not just the US that's feeling the heat. Japan isn't only selling US treasuries. They're pulling out of European debt too. Why? They see the writing on the wall. High inflation, energy crises, and an unstable geopolitical climate are eroding trust in the Eurozone. Japan reduces exposure to European bonds. Amid energy crisis, according to Bloomberg, September 2024. This puts the European Central Bank in a bind. The ECB has already struggled with inflation control, and now they're facing rising borrowing costs. This impacts key players like Germany and France the most, countries with huge deficits relying on low-cost debt to sustain their economies. Germany, France, and Italy would feel the pain first. Germany because of its massive industrial output and reliance on cheap credit. France with its high debt-to-GDP ratio. Italy already facing an economic crisis, would be on the verge of collapse if borrowing costs spike. And it's not just government debt. Corporate debt is on the line too. You might be thinking, what does this have to do with the stock market? Well, here's the deal. Global markets are intertwined. If Japan's Treasury sell-off leads to a drop in bond prices, it pushes interest rates higher. Higher rates mean corporations pay more to borrow. Investors panic. Stocks fall. It's a domino effect. We've seen this before. The 2008 financial crisis wasn't just about mortgages. It was about lost trust. Japan's move signals that trust in U.S. debt is waning. Now let's zoom out to the 2024 U.S. presidential election. On one hand, you've got Donald Trump with his America First economic policy of tariffs and trade wars. On the other hand, Kamala Harris, who supports global alliances and multilateral trade deals. Two vastly different visions. Trump, we're not going to let any country take advantage of us, especially our allies. Kamala Harris, we need strong global partnerships, especially in an increasingly competitive world. Trump's protectionist policies could escalate tensions with Japan, pushing them further away from U.S. debt and into their own currency. Harris, on the other hand, might seek to rebuild trade bridges, encouraging Japan to reinvest in the U.S. market. Either way, this election is shaping the future of U.S.-Japan relations, and the stakes couldn't be higher. So, what happens next? Japan's move to ditch U.S. bonds might be the first crack in the dam. We could be on the verge of a global economic shift, one where the U.S. is no longer the center of financial stability, and the stock market? Well, we might just be watching the beginning of the next major financial crisis. We hope you are enjoying this video. We're thrilled to have you with us today. If our content struck a chord or sparked some inspiration, go ahead and smash that like button and hit subscribe to join our awesome community. Please share this video to help us grow. Your support is super valuable. Check out another video from our channel, which is now on the screen. Thank you.